You can hear my voice. Type in yes or Y. All right. Okay. So the market just keeps raging forward, raging up. Nothing seems to be slowing it down. It's quite amazing to watch, considering everything that's going on. This type of market creates certain opportunities. There's a lot of fuel in the market. So we're going to talk about tonight in our training. We're going to talk about obviously continue with options, but one particular strategy that seems to do well in this type of market is something called covered calls. So we're going to talk about the strategy of covered calls and how to actually set up a trade for covered calls and the rules based around covered calls. Okay. So any questions before we get started? Anybody? Any questions on anything? No, we're all good? Okay. All right. So let's continue. You can obviously ask questions as we go. We're going to continue with understanding options and we talked about how the price is manufactured, what goes into that. One particular area that we're interested in is something called theta. I hope you remember what theta is. Theta is something that measures and values time, and theta is expressed by a number that tells us how quickly a option expires, right, based on the time component value. So when we look at time decay, and I hope you all can see that. Can you all see that all right? Everybody see that okay? Yeah. So if you remember, we talked about time decay, and we can see that time decay accelerates, the value of the option accelerates to zero as time goes by. And because of that, we call this area here the cash flow zone. The reason we call it the cash flow zone is because the acceleration is the highest in that last 30 days, right? You can see that it's very steep. That's because the option contract's running out of time to have any value at all, and we can see that it deteriorates quickly. So this particular area, so we would like to sell this, sell this area, okay? So this is the area that we want to sell, okay? So if this is the area we want to sell, if we're selling options, we want to sell this area because that gives us the best value, right? As a seller, where would be the buying option? Where do you think we'd like to buy? Do you remember we talked about this slightly? Where if we're going to buy options, where do we want to buy? So these are months, right? 4 months, 3 months, 2 months, 1 month. So where do you think we want to buy? Yeah, we want to buy where it's slowest, right? We want to buy where it's slowest. So we'll buy actually anywhere in this area, okay? This is okay for us to buy. But you can see when we're buying these options in this zone right here, right, the third and fourth month, you can see that, in this area here, it really accelerates in here, right? So when we buy options in this area, we don't want to hold on, we want to get rid of it in this area here, okay? So we want to buy over here, we want to sell over here, okay? Now the real cool thing about options is because there's a formula based around it, you can actually calculate probability. Now probability is based on that moment, right, where you're buying the option or selling the option, but it gives us an idea based on a lot of factors that we don't have to work on. We don't have to come up with the numbers or do the formula ourselves. It'll tell us what the actual probability of us being successful as an investor. So option contracts or expiration date. The option expiration is the date in which the option contract becomes invalid, right? Becomes valueless, and the right to exercise it no longer exists, right? So when we look at the option chain, this area here tells us actually how many days are left on that option, right? this area here, right? That's not the best color to use, but so 6 days, 13 days, 20 days, 27. Now those are the actual dates when it expires, but the option days left are right here. So 6, 13, 20, 27, 34, 41. That's how many days are left on this option. Okay. So buyer, we want 2 months plus pay expectation. If you remember, pay is probability of a yield, right? You know how much we're going to make or we expect to make on the trade itself. So when we're buyers of option, we want 2 months plus pay. We're not going to worry about that right now because I want to talk about covered calls. So sellers, 4 to 6 weeks of time. So when we're buying those options, we want to buy, we want to buy 2 months plus pay, which ends up being 3 or 4 months. When we're selling 4 to 6 weeks of time. Okay, which is 4 weeks would be 1 month, right? So 6 weeks maximum. Because that again is the cash flow zone. That's when the acceleration of theta, time decay, and the value of that option deteriorates. Okay, so when we look at those options, right, we talked about theta, which measures time, but delta is very important too. So delta gives us a couple indicators to what's going on with that option in the way of a lot of different variables are being thrown in there. Delta tells us, the rate of change. So if a stock goes up $1, what happens to the option value? Stock goes down $1, what happens to the option value? It also is used, we use it for, really this is the big thing right here, is probability. So what's really cool about how delta works, okay, so probability, probability. So this to me is the most amazing and valuable thing, is it gives us probability. Okay, so delta, you'll see delta as a value of it goes from 1 to 0, and it can be negative or positive delta, and I'll show you what I mean by that in a second. But it gives us the probability of us making money, right? Of us profiting. And if we sell, it tells us what's the probability of us losing money or the person that we sell it to makes money, okay? So when we look at delta, delta is right there, okay? That's delta right there. It shows us the value of delta. It gives us the actual probability and the rate of change. So when we buy options, I don't want you to worry about price. I don't want you to care about the price of the option. I don't want you to care about the price of the stock. We're just looking at delta, okay? And this is very important, okay? We want to be objective when we trade, right? We don't want the movement or the numbers to go into and create emotion that gives us our decision-making process when it comes to investing. So we want to use an indicator like delta to tell us the bottom line, what's the probability of success or failure based on this trade. So when we buy options, we want a delta of 60. Now, if 60 is the delta, decimal 60, what does that mean to us? Well, 60 delta means that I have a 60% chance of profit. That's what it means, okay? A 60% chance of profit. That's what it means, okay? That's what delta is going to tell you. I have a 60% chance of success, right, of being profitable, okay? It also tells us that if the stock goes up $1 or down $1, what's the option price going to do? It's going to move 60 cents. Okay? Okay, 60 cents. So if the stock goes up $1, down $1, the option price is going to change 60 cents. Okay? But this rate of change, I don't want you to worry about this rate of change. I want you to worry and focus on probability. Okay? Probability is really what I want you to focus on. So if I'm buying, when I want to buy an option, I'm looking down the list of options. I'm looking at the delta. And the delta is going to tell me, what's the probability of profitability. I'm looking for a 60 probability when I'm buying an option, okay? Okay, 60 probability. If I'm selling an option, well, I'm going to sell 10 to 40. okay? Maximum 40. So if I'm selling you an option, I obviously want the probability on my side, not on your side. So if I'm going to sell you an option, I'm going to sell it with the probability of 40 or less, which means what? 40%, you have a 40 to 10% chance of being profitable, okay? That's what that means. I'm going to sell you a 40% chance of probability of being successful. So that means 60 to me. Does that make sense to everybody? Is anybody confused right now? Anybody? Comments? Everybody getting this? Yeah? Okay, that's good. All right. Okay. So when I'm selling an option, I'm going to sell. I'm lost, but carry on. Okay. So in an option chain, okay, so eventually I will understand. You're right, you will. So the main thing I want you to understand about options is this, okay? I don't want you, when you look at the option chain, okay, and that's the list of different strike prices and different option values, and it has delta, theta, you can put all the Greeks if you want in there, gamma, you know, we just want to focus on delta, okay? Just delta right now. Delta is going to tell me, without even looking at the price, without even looking at the stock, I can look and start to measure the probability of my success. Isn't that cool? I think it is. It's very, very cool. Okay? So options can actually, because of the sophisticated formula that's used, and it takes all this information and it puts it into the option price, part of that option price is based on delta. Okay? So I'm looking for a delta of 60. Now, what if the delta is below 60? Well, if the delta is below 60, what's it saying? Say the delta was 50. What would that mean? What if the delta was 50? What if the delta was 50? Okay, a lot of people type in. Yeah, basically it's a coin toss, right? 50-50, right? Okay. So yeah, exactly. So 50-50. I mean, we don't want in this particular strategy that I'm teaching you, that I'm showing you, 50 is not good enough. We need to be 60. Okay? So 60 is what we're looking for, okay? Now, some of you might be asking, well, if I'm selling an option, who would want to buy an option that's only got a 10% chance to 40% chance, say, if it's the delta was 40, why would someone buy an option that only gives them a 40% chance of probability? Why would someone do that, you think? Remember, when you're selling options, you're doing the opposite. I'm going to sell you a 40 or less chance of being profitable. Okay? So when I'm buying 60. When I'm selling 10 to 40. Why? Why would someone buy an option that only gives them, say, a 10% chance of being profitable? Going against the odds, okay. Higher return. It could be a higher return, right? But you only get a return if you make money, yeah? Or at least that's what you're trying to do. So think about it. Why would someone buy an option that only gives them a 10% chance of making money? Can you think about that? I'm going to be 1 minute. Just got to step away real quick. I want you to think about that. Why would someone do that? I'm going to be right back, okay? All right, sorry about that. Okay, so is 30-day expiration considered a short time? Okay, so I'm not going to worry about time right now, okay, but I'm going to get into that, I promise, okay? Why would someone buy an option that has only a 10% chance of making money? It's real simple, actually. Give you one more guess. I'm going to stop sharing for a second and do a whiteboard. Okay. Whiteboard. Okay. You already have the 60% from the buyer. What do you mean, Rodrigo? So, look, if I have an option, so let's say ABC stock, okay? Okay, so ABC has options, and let's say that the price is $20, okay? And there's strike prices, so strike prices, okay, are 18, 19, 20, 21, 22, okay? So this right here is where the price of the stock is, okay? The delta, okay? The delta, so this is the price where the stock is, right? The delta, the D, the delta is say 30, 60, 1, 60, 30. Okay, that's the delta. Okay, actually, I'm sorry. My apologies. Well, the delta would be negative or positive based on which side you're on. Okay, so let's say, don't worry about this because this is negative 30. Let's say that you're selling the 22s. Don't worry about these actually. Let's take those out. Okay. So it's delta is 160, 30. Okay. So if I was buying an option, which one would I buy? I'd want to buy that one, right? If I was selling an option, I'd want to sell that one. Okay. So why would someone buy the 30 instead of the 60? It's a call, yeah. We're just going to use it as a call. It could be a put, doesn't really matter, but let's use it as a call. Extrinsic value cost. So the extrinsic cost is going to be different for both these options, right? So it comes down to, you're close, it comes down to price. The price of this one is going to be, say, $1.30. The price of this one, say, is going to be $1. Okay? So why would someone buy the 22? Why, if I sold them the 22, why would they be willing to buy it? Because it costs less. So it comes down to they're being cheap. They're buying the cheaper option because they want to pay less. What they don't realize, or maybe they do realize and they're okay with it, is by paying less, they lose probability. Does that make sense to everybody? Just cheap. You can sell options that have a very, very low probability of success because they're cheap, and people will buy cheap ones. Is delta always calculated from the buyer's perspective? No, I mean it's the opposite for buyer seller, right? So let me give you an example. So if the delta is 60, okay, for the buyer, okay, the buyer, what's the delta? So the delta, say the buyer is 60, the delta for the seller would be 40, right? Percent, right? You can only have 100%. It can only be one, right? So if I'm the buyer, right? If I buy at 60, the seller has a 40, right? So if I buy, this is me buying, if I buy 60, the seller has a 40. If I buy 30, what does the seller have? 70. Everybody see that? Does that make sense to everybody? So if you buy the 40, do you make money by buying the cheap ones? What do you mean, do you make money? I mean, if it goes the right way, you make money, right? you got to remember the delta is connected to, the delta is the price of the option is all calculated through a bunch of different Greeks, right? One of them is delta. So the delta, you know, and let me see if I can bring up something. Hold on. Let me bring up something here. So the delta, if you have a low delta, right? If the delta is, say, 0.01, that means you have a 1% out of 100% chance of making money. That's going to be very inexpensive, right? Now, for us, we would say that's extremely expensive to pay anything for something that's going to give you a 1% chance. I mean, forget about it. You know, the problem, you know, you're basically throwing money away, right? So we want a high probability, right? But we want high profit too, right? So 60 is kind of the sweet spot. So it's better than half, but if you go 70, 80, 90, you're going to pay more, right? You're going to pay more, right? It's obviously, it's the same for us. If we're buying options, the best value, price to value, right, of probability is at 60. Does that make sense? You could buy 90% chance of probability of success, 90, but it's going to cost you more. So for us, having that 60, that's the best value we see for buying an option is 60. 60% probability, we believe, is the right price and the right value for this particular strategy. Okay? So if I buy a 60, the seller who had 60 has a 40% chance, or 40 delta, right? So we're looking for, when we're buying, to have a high probability of success, and when we're selling, we're still looking for a high probability of success. Make sense? Good. When you buy over 5, when we sell below 5, we will have a better chance of making money. So we buy over 0.5, 50%. We have, when we buy at 60, we sell at 40. That's what we're trying to do. We're trying to get the highest probability of success. Yes. Okay. So when we buy, again, yeah. So as these are just rules, right? These are rules, right? So when we buy 0.6, okay, and when we sell, what's here? That's a minute. Might be a little lag here because I'm running a couple of applications. Okay, here we go. When we sell 40. Okay? Make sense? Okay. Let's see if I can show you what. I'll tell you when you get it, it gets very exciting. Very exciting, because you have rules that are very simple, that allow you to look at an option and not be distracted by price. Okay? And as technical traders and the type of traders that we are, price doesn't matter. What matters is what the stock chart tells us or the option chain tells us. Okay? So if you have a stock, at 11.85 and you want to buy a call option with a strike of 11.50 with a delta of 6.1 with an intrinsic value of 115, the intrinsic value would be 115. You would buy a contract of $1.75. If the stock is tending to go down, how come you can assure you're going to get 61%? That's 61% of the profit. That's not what it means, Rodrigo. It means a 61% chance of any profit. Do you see what I'm saying? Right? It doesn't mean you're going to get 61% of the profit. It means you have a 61% chance of profit. No? Oh, okay. Oh, I see. Okay. Give me a stock you want to look at, and I'll show you what I mean. Give me a stock you want to look at. Someone throw out a stock. Air Canada? Okay, hold on. Let's use American stocks if you don't mind for now, just so I can bring them up easily. So I don't have to put the TO text. So here, hold on. Okay. AAL, okay, no problem. It's traded on the New York as AAL, is that right? Okay. Let's look at it together. Okay? Okay, good. All right, so this is an option chain. AAL. Okay. It says American Airlines, you mean? I thought you meant Canada. Okay. Okay, doesn't matter. All right, here we go. Okay, so we see the bid and the ask, right? We see Mark, don't worry about right now. Don't worry about any of these. Worry about delta. See the delta? See the delta? That's delta. Okay? So when you have delta, and remember delta, the delta is based on, you know, the value, that's how they create the value of the option, but you have to take into how many left, right? So the delta is going to increase because my probability, the more time I have, the higher probability I'll have of making money, right? So let's go. Let's go. Let's do this. Okay, well, that's okay. So 23 days, it's okay. We have 23 days, okay? 23 days. Look at the delta. See the delta? Okay? So what is it telling us? It's telling us, right, that the stock price right now is trading at, last price was 12.04, okay? So 12.04 was the last price, it looks like, 12.04, okay? So $12. If we come down to $12, right here, $12, okay? So you see what the delta is? The delta is 0.55. What is it saying? What is it saying? It has a slightly higher chance of going up than going down based on all the other numbers, but it's basically 50-50, 50-50, right? So if I was buying this option, right? If I was buying this particular option, what delta would I want? Well, the closest one to 60, which would be right there. So I would buy this one if I was long. If I wanted to be long on this particular stock, I would be buying this one, the delta of closest to 60, okay? I don't want to be higher or lower. Closest one to 60, that's what I want, okay? So look, after I see this, then I look at the price. But I don't look at the price till I know the delta. Does everybody understand that? Who cares what the price is? I'm trying to be successful as an investor. So I need to, if I'm gonna trade to win, if I'm gonna trade to make money, I have to look at the probability of success. If I was selling this option, I would sell the one closest to 40, which is this one, the 40.414, okay? Which is this price over here. But I don't care about the price just yet. I want to look at probability. Okay, does everybody see that? Okay, so does that make sense to everybody? Good? Make sense? Okay, this is 44 days. You see how it gives you the number of days? 44 days out. Okay, so 44 days out, the delta is going to change, right? The probability is going to change, right? The further out you go, the deltas are going to start to rise because there's more time. Strike at 6.5. What is that? What are you looking at there? I'll go back to what was it? I think it was June. What was this? Isn't that 23 days? 23 days. That's fine. 23 days. Okay. So if I'm looking at this, what are you looking at? June 26th. Okay. So June. Okay, that's it right there. June 26th. Okay. So we're on June 26th. What are you looking at? Strike at 6.5. What's that mean? What do you mean? $6.50 up here? Yeah. Okay. So the delta is basically, I mean, it's basically 1, right? Not quite 1, but if the stock goes up or down $1, you're going to lose 96 or gain 96 cents, 96.54 cents as a trade. So you have a 96% chance of probability of being profitable, right? 96% chance of being profitable. But you got to understand that means this could go down to here. You'd still be you'd still have value. So I should say value of the option is going to be there. So instead of profitability, because you're going to think, well, if I have a 96% chance of being profitable, it has to go up. It doesn't. It just means that there's going to be some value in that option by the end of this expiration of 23 days. So it's saying that in 23 days, this option will still have value. It has a 96.4% chance of having value. Okay, does that make sense? But look what you're paying. You're basically paying, more than the distance between the strike 650 and the price of the stock 12. Does that make sense? It's going to cost more, right, for having a higher probability. Plain and simple, it's going to cost more. So what we've done is designed a strategy that believes that 60% is the best place for a buyer and 40% is the best place for you to sell. Okay, so that's based on back testing. Okay, so those are the numbers that we use. What I wanted you to see was the option chain will tell you the number. You don't have to try to figure that out. It'll tell you the number. Okay, does that make sense to everybody? Any questions about that? We'll come back to it. Don't worry. All right. Okay. So, and there's the rule, right? Buyers 60, sellers 40. Okay. So let's talk about the covered call. Okay. Covered call. So how do covered calls work? Okay. So how do we invest for profit and in the stock market, and how do we invest in real estate to make money? Okay. And this is just a comparison. This isn't knocking stock or real estate, just a comparison. How to generate cash flow with covered calls. So the covered calls is very much like, having, the same concept of controlling property for cash flow, not capital gains for cash flow. Okay, so there's two ways to profit when you're looking at a stock, right? What are the two ways to profit from a stock? What are the two ways we can profit from a stock? I'm asking you guys. What's the two ways to profit from a stock? So you buy a stock. How can you make money? Dividends. Yep, exactly. So dividends and value. Okay, so we make money from dividends and we make money from value. Okay, so dividends and value. So price appreciation, right? Obviously we need, it only works in bull markets. We have to sell the stock to capture the gain. So at some point you got to sell the stock. So as it goes up, and the other one is dividends, right? So you're cutting the profits. So small cash flow, typically it's very small. The S&P 500 paid $249. That was the price at the time. $1.60 paid quarterly, dividend of 1.87. Not very big. You're not going to make a ton of money from the dividends, right? It's small, but that's the other way you make money. Okay, So you invest in the company, you make money if it goes up, and you make money on dividends, okay? In real estate, how do we make money? Well, we make money when the price of the value of the property goes up, just like, just like the stock, and we also make money for renting it out, okay? So appreciation and rent, same concept as the stock market, right? Price goes up, we make money, and we get paid dividends. Of course, the rent, if you structure right, the rent's going to be better than in cash flow than a stock, or at least it would appear, right? But you got to look at how much you put up, right? So when, let's say we had this is just an example. You buy a house for $240K, you put $40,000 down, your loan is $200,000, okay? So how much money do you have in this property right now? $40,000, okay? You don't have the $240, you have $40,000 in this property, okay? The monthly is $1,400 is the monthly cost. That's your expenses, your MO, your monthly operating expense, right? So your monthly operating expense is $1,400, okay? The monthly rent is $1,700, okay? So I want you to take a moment, calculate for me what your yearly cash flow is and your ROI on a year. Go ahead, everybody, do that now. So what's your yearly cash flow? Your yearly cash flow. And what is your return on investment? That's your cash flow, $3,600, good. And what's your return on investment? What's your return on investment? Everybody remembers how to calculate that, right? $9%? Okay. Anybody get a different number? That's right, Henry. 3.6, which okay, divided by 40K. 24K per year, 6% appreciation. What do you mean, Rodrigo? You're looking at the capital value of the stock, of the house. Is that what you mean? Okay, so leave appreciation out right now. Let's just say it does nothing. Okay, imagine it does nothing. So never count on appreciation, right? In the stock, and doing covered calls, we never count on the stock actually going up. Okay, I'm just looking at the rent. Okay, but I appreciate where you're coming from, because obviously it doesn't always go up 6%. It could go down 6%. Okay, but the average is going to be just under 6% in Canada for sure. In the U.S., it's going to be a little bit less, but yeah, there's going to be some appreciation over time. Okay, so correct, 300 positive cash flow per month. Okay, now the one thing, this is just a joke, the one thing you got to deal with is people, right? That's the thing with real estate. You also got to deal with people to make that money. They're your clients, right? So this is just an example. $300 per month. You're going to make, $300 per month, $3,600 per year. You put up $40,000. You're going to make roughly 9% a year on the property. Okay. Well, I don't want to say that. I just want to say this structure doesn't appeal to me, right? 9% doesn't appeal to me, right? If I got 10 or higher, double digits, I wouldn't feel bad about it. But it's just making a comparison between this stock and the real estate. That's all. Okay. So the break even is 11 years. So it takes you 11 years to get your 40,000 back. Does everybody understand how that worked? Right? So if I'm bringing in $3,600 per year, it's going to take me 11 years to get my 40,000 back. Does that make sense to everybody? So 11 years to recoup the property, okay? Recoup the investment, 40,000, okay? This is not taking appreciation, absolutely not taking appreciation into account here. It's just saying, look, if the market doesn't move, because we're looking for cash flow here, we're not looking for capital gains, right? We're just looking for cash flow. So even if you gain appreciation, you have to sell to realize it. We're just talking about cash flow, okay? So covered calls are to a stock investor as rental income is to a real estate investor. So the idea of covered calls is to make money by renting out your stock, like you would rent out a house, okay? So by renting out your stock, you still own the stock, right? But you're renting it out, and for someone to have control of your stock for, say, 30 days, you're going to get paid rent. You're going to get paid rent. That's the same concept as if I buy a house and I rent it out, I'm going to be able to take in money every month from the renter. Is that like for shorting? No, No, this has nothing to do with shorting. Shorting is different. Shorting is different. Nice comparison, easier to understand. Okay, so good. Okay, so covered call. If I buy 100 shares of AMD at 1330, okay, and that's what it's going to cost me, $1,330 down. That's what I got to put up, right? I got to put up to get 100 shares of AMD. That's the stock. If it's trading at 1330, I got to put 1,330. If I sell a covered call, if I sell a call, I own the stock now. I sell a call. I'm going to bring in $60 per month rent. So I get $60 positive cash flow. Now I want you to do the same thing. What's my yearly? What's my return on investment? Go ahead. If I make $60 a month and the price just stays at $13.30, doesn't move. Yeah, absolutely, that's realistic. Absolutely, that's realistic. Oh, that's not a year though. I'm talking about a year. That's a month. Everybody see that? Okay, now you're getting it. Much better than a dividend. Okay? So Rodrigo, we're talking about a year, right? If I make $60 per month, 60 times 12 is how much? That's right. That's right. You got it. All right. So ROI is 4.5 a month. A month. 4.5 a month. Okay? I think somebody put 5.4. 4.5 a month. Let me just do the math on that now. Now see how we got that. Okay? So $60 divided by 1330 is 4.5. I don't know how you guys got 5. You swapped it. It's 4.5. So 4.5 times 12 is 54%, which you did get right. 54%. So Rodrigo, it's 4.5. You see that? Okay, good. Sorry, the person borrowing. So the person borrowing the stock, how does he make money? Well, if you sell him the option, and I'll show you that, if you sell him the option, he could take the stock away from you. But that would be okay. That would be okay. We'll get into that in a second, okay? So, and the big thing is traders love that there's no people involved. There's no people. You just need a broker, internet connection, and you can make this trade. So no people problem. Just a joke. But it's real, right? So how long does it take you to break even? Well, it takes you 2 years, less than 2 years. Like less than 2 years, you get your money back that you've invested. So it's quite appealing, right? Covered calls look really appealing, right? Obviously, if you're guaranteeing income every month, you have to ask yourself, well, what are the risks involved? This looks too easy, right? And I'm going to explain that to you, okay? So when we look at rent, renting out a house, buy it for $240, put 40 down, find the tenant, $1,700 a month, $300 a month to cash flow, 11 years to break even, versus 1,000 of AMD shares, you only have to put up 1,300. Sorry, 1,000, you'd put up 13,300. That was only 100. We did 100 shares. But if you put up 1,000 shares, it would cost you 13,300, which is still less than the 40,000, right? If you sell covered calls, you'll make 600 per month. 600 per month, right? And 600 positive cash flow per month. It'll take you 2 years to break even, okay? So instead of us putting the 40,000 into, say, a house, we can buy shares for 13,300, and we can produce, like rent, $600 a month. Does everybody see that? Okay, good. All right. So obviously you have people on this side, no people problems. Don't take that to heart too much. Obviously, there's money in real estate. I just want to make a comparison between the two and see that, so you see that there's still ways to make cash flow in the stock market. It doesn't have to always be I buy it low and I sell it high kind of stuff. I can make money if the market does nothing. I can still make money, right? I got lost in the covered call price. What do you mean covered call price? This here, Okay, so I'll explain it in a second. Don't worry, don't worry. We'll come to that. So the covered call is a deal between promise to sell a stock and get paid, right? So we make a deal with someone. We say, look, if you want, I'll promise to sell you this stock at a certain price for a certain time, okay? And he says, okay, I'll pay you, rent basically. I'll pay you a premium to let me do that, okay? So if we look at the AMD shares, so you understand what I'm talking about, Rodrigo. Look, if you buy the shares for $13.30, okay, and you sell the strike price at 14, okay, they'll give you 60 cents or $60 per 100 shares, right? So what happens is they have the right to take the stock away from you at 14 bucks. Does that make sense? So you're selling them the 14s. Let me do this right over here for a second. Okay, so let me show you over here for a second, okay? So if AMD, okay, is trading at 13.30, okay, and I sell so I'm going to sell a call. I'm going to sell a call with a strike price of 14 bucks, okay, $14, okay. What does that mean? It means that they can buy the stock from me for $14 for 30 days, okay. Anytime during 30 days, they can buy it for 14 bucks all day, every day. They can buy it for 14 bucks from me, okay. That means if AMD goes up to $16, what can they buy it from me for? $14. Everybody see that? Everybody understand that? So it could go up to 16. They are not going to have to pay more than 14. Okay? And because I give up that right to sell it, to get it for 16, because I'm saying to the person, well, you know what? To guarantee you that I'll sell it to you at 14, you need to pay me how much? 60 cents per share. You got to pay me 60 cents. Does that make sense to everybody? You got to pay me 60 cents, which is how much? Because remember, this is times 100, right? Because that's per share, and you can only do this in 100 lots, right? What does that mean? I make $60. Okay? No, not 70 cents. 60 cents. You're looking at the other slide. You're thinking of the other slide. I'll come back to that. Does that make sense to everybody, though? Everybody gets that, right? We're giving up that right? We're saying, look, man, if this thing goes up to 20 bucks, you only have to pay 14. But for us, we're not looking for capital gains. We're not in this scenario, we're not looking for the price to go up and us make money. We just want to rent it out. We just want to make cash flow per month. We just want that 60 bucks. Is there a type of company or category for this to work best? No. The only requisite you would want is a company that's going sideways to up, right? That's what you want, right? A company that's going sideways to up. And I'll explain why, okay? I'll explain why. Okay? So let's go back. Everybody understands this, right? Well, we're going to get into that. Don't worry. Don't worry. I just want to make sure you understand this. Okay? Everybody understands it, right? That's the main thing. Okay? Here we go. Let's go back over here. Now, if the stock goes up, okay, the stock goes up to 14 bucks, over 14 bucks, they're going to pay us $60. That was for the option, right? And what else do they got to pay? What else do they got to pay? 60 bucks plus 70 bucks because the stock went from 13.30 to 14. So remember, we bought it for 13.30. If they're taking it away, how much are they paying? Well, they're paying us 14 bucks. So they're paying us an extra 70 cents. So we don't make $60 a month on the 100 shares. How much do we make? We make 130 if they take it away. Does that make sense to everybody? Right? So this here was the premium. The no matter what. We make no matter what $60, no matter what we make. But because the stock, say, went to $16, right, and they want the stock now, they get it for what price? They get it for 14. Well, if we bought it for $13.30 and they're paying 14, how much do they have to? How much money do we make on the stock? We make 70 cents, $70. Does that make sense to everybody? So that month we made 130. So instead of the rent only being $60 that month, we made profit $60 rent plus someone took the stock away from us. So we made an extra 70 bucks. So that month we didn't make 4.5%. We made much more, right? We made closer to what? Closer to what? What did we make? If we made 130, we basically made, 10%, close to 10%. Almost 10%, yeah. So do we want the stock to go up? Yeah, hey, if it goes up and they take it away, I'll take that. No problem. They take the stock away from me, I make an extra 70 bucks. Okay? If the stock goes sideways, how much do we make? Well, if the stock stays at exactly, say, 13.30 or, stays below 14, they're not going to take it, right? We make our 60 bucks. So no matter what, we make that 60 bucks. No matter what. Okay? Can you explain in your platform with a real stock? We'll get there. We'll get there. Step at a time. Okay? And if it goes down, whatever we lose $60 less. Okay? Does that make sense to everybody? We lose $60 less, whatever it goes down. Okay? So as an example, okay? I'll go back over here. Okay? So if AMD is at 13.30 and it goes down to 12